About this one. Is this better now? Is this better now? Hopefully there's sound now. You have to lip read. No sound, I have to lip read. Good, good. I'm glad this is good now. Sorry about that. So listen, I want to get this out of the way. Do me a favor, hit the subscribe button if you love the content that we've been dropping here on the Market Minds. Smash that like button as well. That chat, you see that chat? I need that chat to be fired off. So even if you're just saying hi, it would be greatly appreciated. But why don't you check in from where you're located? I am in finally sunny Colorado. Since I've gotten back, we've had nothing but torrential town downpours. But my name is Charles Moon. For those that don't know me, I'm filling in for the great Scott Bauer. And I am filling in on an episode that is right up my alley, as I had stated while I was muted. We're going to be talking about moving averages. So now that we got the good stuff out of the way, let's quickly start with what is a moving average. Well, there's different variations, right? And the two most popular are the ones that we're going to talk about. It is a technical indicator that really combines price points over a specific period of time. It's it's the word average that we're looking at. Now, these averages are barometers or baselines that retail investors and Wall Street will look at in relation to the health and performance of a stock, that's above all their multi-layered time frame moving averages are generally going to be considered really bullish. And if it's below, it's bearish. And if it's below some and above some, it could be short-term bearish, near-term bullish, long-term bearish, short-term there's different variations, but what it's designed to do is really help you understand the sentiment and performance of the stock in relation to the market, will also help you understand the context of the current market environment and trend. What also could be utilized with these levels, if the stock respects these levels, is that these could be pivot points, they could be support and resistance. What's going on, everybody? Beautiful, beautiful. Love to see it. So, is it a lagging indicator? Yes. And everybody's like, oh, I hate lagging indicators, but Wall Street still pays attention to them. So you should as well. And thanks for checking in, everybody. I really appreciate you. So, simple moving average, right? If you look at a chart, that blue line, that's usually what a simple moving average will look like. Now, this is also the most basic, but it's the most popular of the moving averages. It tends to be a lot smoother than the other moving averages in general. In variation, the way that you create these SMAs or what derives the data is that you're going to calculate the closing price of every individual day over the time frame set. So if we're looking at a 10 period, like this example right here, or a 5 period, what it's going to do is take the closing values of the last 10 trading days and then it creates the average. So let's say those are the numbers over the last 5 days, it totals up to 550, and then you take 550 divided by 5 and your average price over the last 5 days have been 110. So ultimately, again, it's a gauge on performance. It doesn't really necessarily account for highs and lows like other moving averages does. This is based on where it closes. And that's important because obviously if a stock has a range of $100 to $90, but it closes at $90, it basically closed on the lows. So the average is going to be the basis of performance during that time frame. And these simple moving averages are really important. If you turn on CNBC, you turn on Bloomberg, or the basic analysis, you Google, technical analysis trading. A lot of them are going to pinpoint towards moving averages, and the simple moving averages is going to be king. Now, for the short-term traders, the exponential moving average is really important in this scenario because the exponential moving average will move and react quicker than the simple moving average. I feel that SMAs are good for more of the broader picture, while EMAs are good for the near term picture and performance. And the EMAs are good for the short term because they, in their formula, give exponential weighting or a greater weighting towards the newer data as opposed to the older data that are tracking. So, for example, if you look at this, it gives, as it stated, more importance to recent prices to make the data more responsive to new information. So the reason for doing that is that we could get a better feel and gauge of the near term sentiment and the real time performance of a stock. And that's really important because when we combine the effects of the SMA and EMAs, when we layer them on a chart, near term, they can look pretty similar. Like a 5 and a 10 EMA would look similar to a 5 and a 10 SMA. But as we start expanding out 20, 50 period or whatever period of time frames you use, you're going to notice there's going to be a stark difference. And the EMA is always going to be sloping a little bit more jagged, a little bit more abrupt than the simple moving averages. So this is really important to understand how to decipher between the two. Now, as I pull this up here, we're going to talk about support and resistance. Now, my assumption is that people understand what support and resistance is, but for those that don't know, these could also be defined as floor and ceiling. The reason why they could be the floor is that they could come down to this moving average and rebound, meaning they pivot and deflect away. And it's the same thing in terms of resistance. They could get to that ceiling price, that moving average, and then start to deflect away. So, what we look for as traders is the price action around these levels, and they're important. These are very popular timeframes and indicators. So, that also means that there's a lot of eyes that are tracking this price range and, I guess, price level, and how it reacts is how traders are going to take on trades or manage their trades. So it could have a not only immediate and significant effect on the stock price, but a residual effect as well, as it may, garner some momentum as it deflects away and sellers start piling on the pressure. Or if it breaks resistance, then of course it could cause a short-term short squeeze, as buyers now are saying we're above resistance and sellers realizing the same thing, and effectively it becomes a one-sided market. As well, crossovers are really important. If you've been involved in any of my programs, especially the momentum stock program, you'll understand the variables of crossovers and the value that I find in them. Now, for example, a crossover is when the shorter term moving average is crossing above or below a longer term moving average. So we would have the same indicator, let's just say a 20 EMA, right? And then we want to weigh that against a 50 EMA. So they're the same indicator, but different time frames. The 50 EMA will have more collective data underneath it. And so what ends up happening is that we could see this moving average will represent the 20 as red, okay? And then we'll represent the 50 as blue. And so we could see a point where a stock gets really, really bearish once the faster moving averages crosses below the longer one, and get really, really bullish once the faster moving averages crosses above the longer one. And Robert says it in the chat, death cross, golden cross. Now, the death cross, golden cross is actually going to be defined in relation to the 50-day simple moving average comparison to the 200-day moving average. So when the 50 crosses below the 200-day on the daily chart, it's known as the death cross. And when it crosses above, it's known as the golden cross. Now, I want everybody to understand, because I also run another program called the AI program. And the AI program actually incorporates a combination of both the simple moving averages and the exponential moving averages. Now, if we take a look here, right there, those two lines right there are EMAs. They're the 10 EMA and the 21 EMA. So very short time frames. My simple moving averages are going to be highlighted in yellow. There's your 20 your 50, and off the screen is the 200. So if you notice, my moving averages generally tends to be longer term and my EMAs tend to be shorter term. And again, this is by design. Remember, the shorter EMAs or the EMA moving average is better relative to the shorter time frames. So day traders, swing traders, and the SMAs are going to be far more prevalent on a longer time frame. So we're looking at, hourly to, daily projection horizons. For me, I find that simple moving averages are best valued and best performing on a daily chart. And the EMAs are very effective in a short-term time frame from the daily chart all the way to a 3-minute chart. And in fact, we look for simple crossover moves. One of the trades that I called this morning in the Momo room was the SPY trade. We're probably up around three, maybe even close to $4 right now. But if we look at what happened today, they bounced pretty aggressively off of the um, 10 EMA. They bounced really aggressively off the 200 SMA on Friday. And if you take a look, our faster moving average, which is highlighted by green, is crossing over the slower moving averages, which is highlighted right here. And so in that circle, I'll even pinpoint to the moment that it crossed over, really indicated that the markets, and more importantly, this stock, which is the SPY, which is an ETF of the markets, wanted to move higher. And I felt it was a good low risk, high reward opportunity. And so far, it is proving its value. Now, again, when we want to look at the EMA values, right? The EMAs have sufficiently a lot less lag than the SMAs because the weighting is more on the near term data versus the entire collective. And what it really does is effectively adjust a lot quicker than the SMAs. But the SMAs, in my opinion, will be more relative when it comes to support and resistance because it's a well-rounded moving average. And for whatever reason, Wall Street likes to pinpoint specifically far more to the SMAs as support and resistance versus the EMAs. Now, the longer the time frame, the slower the reaction is going to be because, if you take, let's say, 98 bars, and the average output is at 98 and the last two are at 120, while it will help adjust the moving averages slightly higher, it won't have it screaming up. It'll only be a slight adjustment. And so we got to remember it is the large collective of data when it comes to the SMAs. And that large collective is generally viewed as a baseline in performance. Again, with the 50 SMA, that's tracking about the last quarter of data. So you could see how it's a bit shorter term, where the 200 SMA essentially is tracking almost the last calendar year of data. And so when stocks start to slide underneath that 200 SMA, sometimes that slide could be really, really aggressive. And it's the same thing in relation when stocks tend to recover above this level, it could get very, very bullish. So if we look here, this teal blue line represents the 200 SMA. Look at how aggressively the market pulled back away from that level. And then once again, when it cleared above this level, look how easy the SPY marched up, even though they pulled back. Again, what a rebound, what an aggressive jump in the market environment so far. And we could even relate that to the NASDAQ and the Qs. And if we look at the Qs, well, look at how strong it's been performing once it's gotten above this threshold of the 200 SMA. I honestly didn't think that the recovery in this market was going to be so quickly, but certainly once the news started raining really positive, up and away we go. And again, what do you see here, folks? You could see the faster moving averages crossing above the slower ones. So the Qs and the SPY look eerily similar, right, in terms of performance. Now, can there be fake outs with crossovers? 100%. Generally speaking, I like when the faster crossover is sharply put and it starts to create a little bit of separation between the fast versus slower moving averages. If you can see, it has this fanning effect where the fan starts to open wide, right? Those handheld fans. So that's usually what you want to see in relation to crossovers. Dynamic strength initially with follow through momentum. Whew. Did I lose anybody? Is anybody confused by what I had said? All right, very quickly, folks, because I need to give my guys some time, and looks like we have a decent amount of people logging in. Today's word of the day is going to be simple. So, we usually have these drawings at the end of the episode. If you wish to be entered, do me a favor, type in the word simple so we could get your name on the wheel and have you potentially qualify for some pretty cool swag. Yes, yes, yes. So, SIMPL or SMPL, I guess that would qualify as well. So, if we look at a lot of stocks today and how they perform, let's look at a name like Tesla, for example, right? Tesla really standing out to me, up around $22. And you could see that, in relation to where they've been on their crossovers. Well, they had a pretty aggressive crossover here, but we saw the other follow through today on that crossover. Look how strong it is. And if we relate this, well, the information, I don't know if anybody saw the news on Tesla, but when I woke up randomly, I think it was like 3:30 in the morning to go to the bathroom, I flipped open the CNBC app, and first thing it said was European sales declining 49% for Tesla. It doesn't sound bullish, but apparently the risk on move is because Tesla's hinting at robo taxis coming out this summer. So we'll see. But the reason why I wanted to point out Tesla is that earlier I pointed out our faster moving averages, the EMAs. So if you notice, Tesla came down to that level, did not get underneath. In fact, they kept trying to hold on that level and eventually was successful enough that when it started to gain a little upside momentum, we had crossed over here on the right and away we go. Only up $22 today. Not too bad. Not too bad. Now, if we look at it from a different standpoint, a retail favorite name, Palantir. Well, the markets are up 439 points in the NASDAQ, a cool 2.34%. Palantir is down for the day. Now, again, Palantir still holding on to their 20 SMA, but if you notice, we are now actually starting to cross over to the downside. And that's really giving me a negative indication. There's your crossover right there. So the one that's sloping down here, that's the 5 to 12. So we could even say it's a 12 EMA. And right here is the 50. So effectively, the near term performance is vastly underperforming their baseline average, which is their 50 EMA or the performance of the stock over the last 50 trading hours. It's pretty darn weak. So we need to be very cautious in this name because if they don't hold the support on the daily chart, this could be a quick flush out as low as 115, perhaps even as low as 110. And people don't think that Palantir could drop back, but why not? Remember, weakness is weakness is weakness. Hopefully, Palantir recovers because I know a lot of people love to buy the dip on Palantir, and rightfully so. It's been a great performer, but you just have to be a little bit cautious in this instance. Doji is barely in the news anymore. Yeah, Doji. Yeah. Yeah, I don't know if Elon actually ever is going to do anything in relation to the Department of whatever it was governing efficiency. I don't know. Boeing is effectively peaking out. They are really close for me to say it's starting to look like a trend reversal sign. They're holding on to the 10 EMA on the daily chart right now, but I feel like if they lose this level right here at 196, they're going to work their way down to 177s. Again, if we look back here and let me just condense this really quick, you could see that this stock has had some ebbs and flows, but since they crossed over to the downside, they did it again, and they've really been really effectively working lower. As well, this level right here, which I'm going to highlight, this little highlighter, that yellow line is the 200 EMA on the hourly time frame, and they're now stuck below this level. Now, if you don't know what I mean by getting stuck below that level, let me just kind of zoom this out. Zoom, zoom, zoom. Okay, so let me highlight it again. This is the yellow level. Okay, and it's important to know this level, by the way. Okay, so they have been trying to utilize it as support here, and today it became resistance. So, what happens when support becomes immediate resistance? Well, I'll tell you one thing, it's not bullish. It's not it's generally typically not a bullish sign. So as you can see, what's starting to happen is that we're starting to get our crossover. There it is. It just got underneath the 50, and they're now trying to cross underneath the 200 EMA. So remember, we talked about it, right? When the 50 EMA crosses, or the 50 SMA crosses below the 200 SMA, that's known as the death cross. So, very similar fixture possibly happening. Again, 196, that's the key price. You could hold me to it. If it loses 196, I feel it could easily come down to 177s. So again, folks, we're not going to talk about stocks. We'd love to hear you folks, and make sure that you are signed up for our giveaway at the end of this show. Make sure you type in the word SIMPL or Sierra India Mike Papa Lima Echo or simple into the chat if you wish to be entered. So yeah, the last two that I want to do, I want to focus on the broad markets to kind of give, because one of the things I started off the trading day today was people are still trading with fear, and I don't understand it. I do not understand it one bit. What are we so fearful of, folks? What is there to be fearful of? What, tariff news? Every time we've had tariff news, it's turned into an incredible buying opportunity over the last month and a half. And, if fear is going to continue to hinder your results, well, I just need to kindly remind you how big of a move the markets have made. I mentioned earlier that Meta is only 125 points off their lows. I believe Tesla is the same. I believe Nvidia is 80 points off of their lows. So, we've always sat back, here and there, and have mentioned to ourselves, man, if I ever get a chance, I missed this move on Meta, but if I ever get a chance to buy on this big pullback, I got to do it. And we've had that opportunity. And there is an incredible amount of people that were just too scared to buy. And I'm telling you, folks, what is there to be fearful of? Yeah, we hear the doom and gloom about the bond market. Markets go up. Stocks still go up. We hear doom and gloom about tariffs. Oh, negative tariffs. Oh, don't worry. 90-day extension, 30-day extension. The market has been incredibly resilient. And listen, if that tariff news didn't crater us, which it didn't, well, this is what you have to look for: spiky rebounds. Because you can't let, right? Look at my box here. You can't let the tariff news affect, right, what the current market environment is, which is going to be highlighted in white. These are two different totally markets, folks. So you have to make the adjustments in relation to the markets. Listen, don't think, trade. There are a lot more smarter people that are risking millions upon billions upon maybe even trillions of dollars. They're buying. Why shouldn't we be? If they're willing to risk a couple of million, I think we could risk a couple of $100. Listen, Don't let the external sources change the fact that we've been going up and not down over the last 2.5 months. People don't realize this. Think about where we are with the SPY. We are not that far off from all time highs, 23 points. We're over 100 points off the lows. I'll tell you one thing. You want to know if the market's in a good place? We're going to see the IWM ascend. And we'll notice the moment they start breaking 210 and looking to break above the 200-day moving average. And how do we know if we're going to be bullish in the DIA, which I just showed? Well, Dow Jones, we're at a make or break price, folks. We're at the 200-day moving average. Can they get above or will they reject? This is a prime example of what to watch if you want this to be a learning lesson on the Dow. Let's see what it does here this week at this 200-day moving average. Okay, folks? So the wheel is now closed. Okay, the wheel is now closed, ladies and gentlemen. Thanks for all those that have participated. Where's the wheel? Do we do this drawing now or later? We should do this drawing now. I don't know where the wheel is. Oh, there it is. Do, 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 do. Oh, I haven't done this in a while, so forgive me. All right, folks. So if we are ready, let's do this again. All right, everybody, good luck. And today's winner of Market Minds is going to be. It was almost time. It was Dave Roberts. What's up, baby? Congratulations. I think you have to reach out to Prosper Swag at prospertrading.com. Can you do me a favor, Mr. Clark, if you could post that link in the chat? I would really appreciate it. There you go. This guy didn't need to win, but I'm glad he won. This is my man. All right, everybody. I just want to say that I hope the short breakdown on the EMA versus SMAs at least gave a little bit of clarity so that, for those that are obviously utilizing this, you probably already knew, but if not, maybe you took away from something and today became a great lesson. Once again, we really would appreciate you folks liking this video. You've done great in the chat. Make sure you subscribe to the channel and tune in because we will be back with more beautiful content. And until then, and until next time, peace and love. I am out of here.